Hi everyone, we are now going to review our practice problems for chapter 14. So I'm on page 820 of our book, and the first problem we're going to look at is problem 14.1, parts 1 and 2. So we have on January 1, 2021, Instaform Inc. issued 10% bonds. Remember, that's our contract rate with a face amount. So that's our principal of $50 million, dated January 1. The bonds mature in 20 years. The market yield for bonds of similar risk and maturity is 12%. So our market rate of interest is 12%. Interest is paid twice a year. So the first thing we have to do takes us back to our chapter 6, present value, is determine the price of the bonds at January 1 and prepare the journal entry to record their issuance. So remember, we have two distinct components of a bond. We have the principal that will be paid back at one point in time in 20 years. And then we have the interest payments. Now, I always start with the interest payments. First, calculate the total amount, the total value of the interest at each payment date. So we'll take the $50 million times 10%. Since interest is paid twice a year, we'll multiply that by 1/2. So the interest is $2,500,000. Now, we need to determine the present value of those 6-month interest rates. So we need to know how much are we willing today to pay to receive $2.5 million over the next 20 years for 40 interest payments. So N is 40, but we use the market interest rate to determine the discounting or the present value. So they use a 6% interest rate because there's interest paid twice a year, so 12% divided by 2. Interest is always paid at the end of a period, so we're going to use the present value of an ordinary annuity table with N is 40, I is 6%. Multiply the factor times the interest of 2.5 million. So what this is saying is that a person is willing to pay $37,615,750 today to receive those $2.5 million in payments over the next 20 years. The other thing we need to determine is how much somebody is willing to pay today in order to receive $50 million at the end of 20 years. We use the same N and I to calculate the present value for the principal. So N would be 40, I would be the 6%. See, that's why I like starting with the interest first. So we go to the present value of 1, since that is just one payment in the future, the other part of a bond. Add those two results together, the selling price of that $50 million bond is $42,476,750. Now, to record it, we will debit cash $42,476,750, credit the bonds payable for the full principal. The difference of $7,523,250 is debited to our contra account discount on bonds payable. Remember what that truly is. It's the difference in price because interest rates are different. So it's really interest. Since the corporation cannot white out the 10% and make it 12% on their bond, they have to do something to entice people to buy their bond. So since they can't physically pay them more cash every 6 months, they could accomplish this by charging less upfront and paying the whole $50 million back at the end. So in the end, the bondholder will really receive 12% in interest. Now in the second part, they go, now assume instead the market interest rate is 9%. How would your calculation change? Well, now we're going to use 9% as our market interest rate. Still paying out interest at $2.5 million, but now our N would be 4.5% and, our I would be 4.5%, 9% market rate divided by 2 interest payments a year, and our N is 40. So now, how much is that interest worth today? $46,003,950. We do the same thing with the $50 million principal. What's it worth today? N is 40, I is your 4.5%. Use the present value of one table for that because it's only a one payment. The interest is every 6 months. There's 40 payments of it. So you get the value of that there of 8.596500. Add them together. The present value of the bond, the selling price of the bond is actually above the face value. It's at $54,600,450. So in this case, the bond sold for more. They sell for a premium. We debit cash for the full selling amount. We credit bonds payable only for the principal. The difference is credited to an adjunct account, premium on bonds, and that balance is added to the bonds payable account to determine its carrying value. Now, why did we receive more? Because everybody else is paying less interest than us, 9%. We're paying 10%. So we want to now make up for that difference in interest. Since we can't change our interest rate to 9%, we charge our bondholders more upfront. So they're really prepaying for that extra amount of interest they're receiving each interest payment date. So great review on how to determine the selling price of a bond. Remember, you're using market rate as your interest calculator. And interest are annuity payments. They're the same amount every 6 months in this case. So it's a present value of an ordinary annuity you'll be calculating. And the principal is a one-time payment. So what's its value today of that future one-time payment? Calculate for a discount or a premium. Now we're going to go to 14.6. Oh, I don't want to use that. Let me see something. Sorry about that. I think I'm going to change that up. Yeah, I don't like that one. Let's see. What do I have as your problem? 14.3. Okay. Sorry about this. I will get us another problem in 2 seconds. 14.3, that's a beautiful problem. What we're going to do is instead, I didn't notice that. I think we're going to use 14.7, which is on page 822. Now in 14.7, let me get to the answer key there. 2 hours later, sorry about this. Yeah, that's a cute problem, but not what we want. Oh my goodness, 14.6 is too long. Good, I'm glad we bypassed it. Let's go to 14.7. In 14.7, we have McWhirter Instruments sold 400 million 8% bonds. Remember, that's the face value and the contract rate, dated January 1. The bonds mature on December 31st in 20 years. Bonds are selling at 10% in the market, so that's the market interest rate. It's paid semi-annually, the interest. Blanton Technologies purchased 400,000 of the bonds as a long-term investment. Okay, so first of all, we're going to look at this from the perspective of McWhirter, the corporation. How much did they sell all the bonds for? And here's another great review of determining bond selling price. Interest is 16 million. 8% times 400 million times 6/12. So every 6 months, $16 million is being paid out as interest. What's the present value of those payments? N is 40, 20 years, 2 interest payments a year. Interest we use to calculate the present value is the market value. 10% divided by 2 because there's 2 interest payments a year. So the factor, ordinary annuity, present value, N is 40, I is 5%. You will use 17.15909. 274,545,440 is the value of the interest portion of the bond. There's also a one-time payment in 20 years, 400 million. We're going to find the present value of that using N is 40 and I is 5. Present value of 1 comes out to be 56,820,000. So these bonds are selling for 331, 365, 440. So the day the bond is sold, we'll debit cash 331, 365, 440, debit discount on bonds payable 68,634,560, and we'll credit the bonds payable. Now this chapter, it's focusing on what does the corporation do. But of course they throw in, well, Blayton bought some of these bonds. How will they record them? Well, the 400,000 or the 1% they bought will be debited to investment in bonds. So this is the company buying them. They're going to credit cash, 0.1% they're buying them at. Sorry about that. Yeah, so 400,000 divided by 4 million. 4, one more zero. I don't even have, yeah, I got a 400,000. Sorry about that. 400 million is 0.001. So 0.001 of A will be recorded. So investment in bonds, those are an asset to Blayton. That's the name of the company, right? Blanton. Discount on investment in bonds, which is a contra account to the investments, is 0.001% of all the discounts, and then the cash. Okay, but I want to focus on what's the journal entry to record the interest payment on June 30th using what we call the effective interest rate method. Of course, there is nothing here to show us that. Okay. So what I'm going to do, they don't ask us to do this, but I love tables. And this is a very common table that companies use to do this calculation. I might have to add an extra one. Okay. We have the date, the carrying value of 1/1, or as of, okay, beginning, interest, oops, sorry about that. Interest expense. This might be a little bit different than what you say. I'm going to do it this way. Cash. No, I'm doing it. Sorry about that. Just bear with me. My brain. Okay. Cash. Deduction to discount. Okay. And then carrying value. End. We could probably add 1 or 2 more columns here. But essentially what this does is, it is, there we go, drop down here. It is keeping track of how much discount, in this case, we're writing off. And it's a special type of calculation. Now, some companies can use straight line. They could just say, what's my total discount? How many interest payment periods do I have? And I'll just equally spread that discount out over the next 40 interest payments. But a more accurate way of spreading out the discount is through what we call the effective interest method. So we're going to start with the first day of this bond, and the carrying value the first day of the bond is the sale amount, 331, 365, 440. Okay. This will now be used to determine how much we should debit interest expense for, how much we should credit cash for, and how much we should credit or reduce the discount. Remember what the discount account is. It's the difference between the face value of the loan or of the bond and the selling price, which is essentially interest. The reason these are different is because the interest rates are different. Instead of calling this all interest expense the day we sell the bond, we can't, because this interest will occur over the next 40 interest payments, 20 years. So we show some of it each interest payment date. We're just showing you how we calculate the amount you will take out of the discount on bonds payable and put into interest expense. So what we do is we take, so this will be our 6/30, our first interest payment date. So the carrying value is what is used, so 331365440. So that was our carrying value as of the beginning of this interest payment period. What we do is, and I'll put the calculation up here, we take the carrying value of the bond, CV, times the market rate times time. So you're going to take, and that's the market rate as of the day we sold the bond, that 10%. Am I wrong? Yes, 10%. So we take 331, 365, 440, the current carrying value, CV, times the market rate the day we sold the bond, it's every 6 months, so 6/12. And I wish the numbers weren't so big. Let's see. Yes. 331, 365, 440 times 0.1 times. I'm getting a number higher than they are. I'm putting something wrong in my calculator. 365, 440 times 0.05. There we go. 16,000. I hate these big numbers, but 16,568,272. So what we actually calculated there was the amount we debit interest expense for. And that's how we determine it, using the effective interest method. Carrying value of the bond, market rate the day we sold it, times the time factor. Now, how much cash is going to be paid? Well, we take the face value of the bond times the contract rate of interest times time. So you can see down here, the face value of the bond is 400 million, 400, times 0.08 times 0.5 or 6/12, $16 million. And once you calculate that, it stays constant because it's contract. The cash doesn't change. The difference between what we calculate as interest expense and how much of that interest expense is paid out as cash, and you could look at this as A there and whoops, B here. It's just the difference between the amount of interest expense we're recognizing and the part that's being paid out as cash. The rest of it is how much we are really recognizing of the discount on bonds payable. And now you could see our journal entry down below. Debit interest expense, 16,568,272. Credit cash for the 16 million. Credit the discount on bonds payable, but remember, you're reducing the discount on bonds payable when you do that. I'm just going to make that a little bigger there. There we go. Now, our discount on bonds payable, what I like to do is keep a T account of my discount and or premium. So up here, my discount account was initially debited for $68,634,560. What did I just do? I credit it for $568,272. So 68,634,560 minus 568,272. I hate these big numbers, sorry. 68,660 minus 568,272. Now the balance of the discount account has decreased to 68,066,288. So what does that do to my carrying value? Well, now my carrying value will actually increase. It's at 400 million minus, sorry, I'm having a hard time with my calculator, 68,066,288. So now the carrying value actually increases for the amount of the discount we wrote off. Yeah, because we're going to be subtracting 568,272 less. If you took the 331,365,440, subtract the 331,933,712, 568,272. So whenever we write down, we move some of the discount into the interest expense, and that's essentially what we did, the carrying value of our bond will increase. Now we could take 0.001% of those items to determine the impact on Blanton Technology. I'm not too concerned about that. I'm more worried about McWhirton's impact. Let's see what happens on December 31st. First of all, the carrying value that will be used to calculate the interest expense will be 331,933,712. 331,933,712. Again, take the market rate of interest at the time the bond was sold, 10%, times the time factor. So 16,596,686. Cash amount remains constant. We always promise to pay $16 million every 6 months. So the difference between the 16,596,686 and the 16 million actually paid of that is the amount will decrease. So it's like a plug. We're decreasing then the discount. That's how much of it we recognize as interest expense. You could see the journal entry down here. Debit interest expense for the 16,596,686, credit cash, and the difference is credited or reduces the discount account. Now remember the impact that has on the carrying value. It increases it. If we decrease the amount, we're subtracting. If we decrease the discount amount, we're subtracting less from the face value to get the new current carrying value. So that means carrying value is increasing. 3,031,933,712 minus 590 plus 596,686. So now our carrying value will be at 332,530,398, and it will continue to increase until it reaches 400 million. Now the investor would debit cash for 0.001 of the 16 million. They would debit their discount on investment for 0.001 of the 596,686, and they would credit interest revenue because to the investor, the one who bought the bond, this is revenue. But I like focusing really from that corporate side, especially in this chapter. But authors love to throw both of these in here. So this is the effective interest method. And I encourage you, you can make an Excel spreadsheet and do all 40 interest payments. And you will see that when you finish, it will be, the carrying value will be at 0. You would have reduced the discount on bonds payable for the entire $68,634,560, properly recognizing it over the life of the bond as interest expense. Okay, and our final problem is actually a switch. It goes to a note, and it's a non-interest bearing installment note, problem 1412 on page 822. So here we have, at the beginning of 2021, VHF Industries acquired a machine with a fair value of $6,074,700 by issuing a 4-year non-interest-bearing note in the face amount of $8 million. It's going to be paid in 4 annual installments of $2 million at the end of each year. So what is the effective rate of interest implicit in the agreement? Because they don't come out and tell us an interest rate. And then we'll prepare the journal entry to record the purchase of the machine and the first installment payment. And then the top of the next page, the journal entry for the second installment payment. And then we have a variation. So let's take this one at a time. First of all, not 1412. If we take the installment payment of $2 million divided by the present value, that's not our interest rate, but that's giving us a present value table amount. We know there's 4 payments every year, $2 million a year. So what's the I? Go to present value of a ordinary annuity, the 4 row, and go across until you find the factor of 3.03735. So the interest rate is about 12%. Now you could do this on your calculator as well, if you have the ability to do the finance calculation. But that's how you would find what is the implicit interest rate. Now the day they buy the equipment, they'll debit equipment for $6,074,700 and credit the notes payable for its fair value. Or its present value, I'm sorry, its present value. Each time there is an interest payment and a $2 million payment. Remember, they're not just paying for the equipment, but also interest. So we've got to figure out how much of that $2 million payment is interest. And that's the first thing you calculate. You take the current balance of the note, $6,074,700, times that implicit interest rate that you calculate. So the interest portion of that $2 million is $728,964. The difference is how much you reduce the principal of the note, the principal of $6,074,700 by debiting it, and then credit cash. Now this is going to impact next year's payment, the second year payment, because take a look at what happens. Interest expense is always calculated on the outstanding balance of the note, just like we do with the bond. Take $6,074,700 original principal, subtract the amount of principal that decreased it last year. $6,074,700 plus 1271036 minus. Let me make sure I did that right. No. I'm using a desktop calculator instead of just using my normal calculator. But if you take $6,074,700 minus the part of the principal that was paid off last year of $1,270,1036, that's your outstanding balance of your loan. Multiply that by the 12% implicit interest rate. It's for 1 year because they're annual payments. So $576,440 of that $2 million payment is considered interest. The difference is what decreases the principal. And you would decrease the principal or that outstanding balance by the $1,423,560, and then use that new outstanding balance to calculate the next year's interest. and determine how much of the $2 million payment would be allocated to the interest and how much would reduce the principal. Now, in the final calculation, they said assume instead the market value was unknown at the time of purchase, but you do know the market interest rate for similar notes is at 11%. So in this case, we don't know this like we did in the first scenario. So we will calculate the best we can what the fair value of the equipment is by taking present value of an ordinary annuity for 4 periods at 11% interest. Go to that table, find the factor. That times the payment of $2 million is what's considered to be the present value of the note. So that's what we would use for the fair value or the value of the equipment because we don't have a fair value. So this is the next best thing. Debit equipment for $6,204,900. Credit notes payable for $6,204,900. Again, when you're doing your journal entries for the payment, now you'll take the outstanding balance of the loan, but times it by 11% and do the same type of allocation. First, allocate that computation amount to interest expense, and the difference between the cash payment and the interest expense portion is a reduction to the principal. Okay, so great review of bonds, how to determine the selling price, how to amortize the discount. You amortize the premium in the same manner, and how we handle notes. So I know there's a lot of information in this chapter. Please be sure you post any questions you have to the discussion board.